To our econs and market. Welcome to our economics and market implications call. And of course, this is in relationship to the large reciprocal tariffs which were imposed by the Trump White House overnight. 2nd of April for us, it's 3rd of April, but it's not really been a full day since all this hit the markets. In fact, the U.S. markets haven't really opened since the announcements, and we will see what happens when it opens. The futures, of course, suggest a resounding negative reaction with broad indices down about 2.5% to 3%, and large stocks like Tesla and Nvidia and so on, all down about 8% or so. Apple down 3%. So what we will do on this call to keep it somewhat manageable, we will not have our 13 colleagues, spend 2-3 minutes each talking about their individual countries or sectors. That would be, I think, rather messy. So let's do it the following way. I will begin with a set of slides, 5 or 6, informing our general thinking on the tariffs and its implication, including something that I put together a little while ago in cooperation with all our economists about the growth at risk analysis, given what has just happened and where we think things are going to go. After that, we will go straight to Q&A, because looking at Pigeonhole right now, we have 16 dozen and a half questions already, and we encourage you to send in more questions as we go through the call. So as soon as I'm done, instead of going colleague by colleague, we will just go straight to Q&A, and we'll take questions, and that would be designated to the specific analyst, and we will do it. And there are some slides after my slides which they can then refer to. So let's do it that way, and let's get right to it. And by the way, the screen, you can see right now the Pigeonhole option, both the QR code as well as dbs.pigeonhole.at as the website where you can enter the passcode R9M64K. And also, this is a WebEx call. We have a WebEx chat screen, so you don't have to go to Pigeonhole. You can also type your questions in the chat section. One of our colleagues, Eugene Liao, is keeping an eye on that. Very well. The quote-unquote Liberation Day, somebody told me today is actually Termination Day. We need to sort of appreciate the gravity of what has just transpired. Focus on that tiny box I have on the left bottom corner of the screen. Sort of looks at the history of tariffs in the U.S. I mean, this is not the first time that America has its romance with tariff. In the 1800s, for a large part of the century, U.S. had very high tariffs, and then in 1890s, William McKinley, who initially was the head of the House Ways and Means Committee and then became the President of the United States in 1896, under him, average rate on duty-able imports were 50%, average rate on all imports were about 20%. Tariffs then came down, went back up again during the 1930s, the infamous Hawley-Smoot tariffs, when average rate on duty-able imports was 60% and average rate on everything was 20%. When I was a student of economics, and I'm sure most of my colleagues will relate to what I'm about to say, we used to look at these numbers as relics of history, things that people did in the past, but you just learn it for the sake of learning it, because surely these things can never ever happen again. Then came Trump 1.0, and he had almost 10% rate on duty-able imports. But if you think about it, even then, average rate on all imports didn't really go up. It was about 3%, I think 2.8 to be precise. As of this morning, we now have duties ranging from 10 to 60%. I say 60 because when you add up the Biden-era tariffs plus the 20% tariff that Trump had already put on Chinese imports, and plus today's numbers, Chinese imports, contrary to what the press is saying, contrary to what I have on the third bullet on the screen, is not 54%. It's in the 60 range. And that would take the average rate on all imports to over 20%. Now, why don't I have a precise number there? Because the message from the Trump administration is so mixed. The clarity on what is going to be levied when and how is so poor that it is not possible to come up with a specific number. I can offer you multiple websites from bipartisan institutes, from research houses, and you will see numbers ranging from 19 to 25 on the average rate of tariffs. And this also tells you the sign of the times as to how all over the place the actions of the Trump administration has been so far. I'm not going to belabor the point of what has been announced this morning. Everybody who's dialing to the call knows very well that there's auto tariffs going into effect tonight. Canada, Mexico are not included in a reciprocal tariff, but they already have to deal with 25% tariff on most imports. I think there will be some exemptions here and there. We'll talk about this later, pharma, chips, but by and large, average rate on all imports for the US is about to go to 20%. It was close to zero 10 years ago. So that's the kind of shock we're talking about. Now, let's try to appreciate the situation in a visual manner. Reciprocal rates announced this morning on the horizontal axis, and the share of exports to the US, country by country, on the vertical axis. So when you glance at this chart, it looks really bad for Vietnam. Massive exposure of their exports to the US and massive 46% reciprocal tariff announced this morning. It looks really good for Singapore. Only barely 10% export share to the US and 10% reciprocal rate. I think you can see just from the stock market reaction at these two ends of the spectrum how the market is also looking at it. Not very, very favorable as far as Vietnam is concerned, not particularly worried as far as Singapore is concerned. Then you have all these countries in between. Hong Kong looks benign, Hong Kong doesn't look benign given the reciprocal rate going up, but its vulnerability may not be that large because Hong Kong actually is not in the goods trading business anyway. Most of its GDP comes from services value added as opposed to manufacturing. But Hong Kong has been a very critical conduit for sub $800 shipments to the US for Chinese brands like Shein and Temu. That all ended this morning. The de minimis exemption for goods shipped to the US under $800 has been taken away. I think it's now 30% or $25, whichever less, depending on the value of the shipment. So Hong Kong's vulnerability is there too. Don't necessarily look at this chart and say it's a completely different situation, but the reciprocal tariffs will be disruptive. And then we have all these things in between. I think we've seen already quite a few concerned questions on Thailand. I will let Han-Teng Chua address those things. China, our entire China team is on this call. They'll talk a little bit about the growth implications on China. Then Taiwan. Frankly speaking, I didn't see such a large number for Taiwan coming. Maybe Mati, who's also in this call, was expecting something like this, but this is big for me. It's not just a matter of semiconductor chips. There are a lot of electronics products. In fact, I think just about every single laptop we have in this room are either assembled in China or Taiwan. These Lenovo products or the HP products. And they are representation of Southeast Asian globalization, meaning chips from Singapore, parts from Thailand, parts from Vietnam, everything go together, parts from China, to produce these electronics that are, basically the blood of modern life. And all of those things would be subject to that 32% tariff coming out of Taiwan. Then you have the likes of even India, which has been levied pretty high. I'm going to go through sort of a set of ideas that, I'm assuming that, many of our clients who are on this call right now are thinking through, how to prepare or how to get their business calibrated toward what's going on. I wrote these things down this morning with a reinsurer in mind, but then I realized that it's not just a reinsurer who would have to go through a checklist like this. This could be for an asset manager anywhere, for a CFO or anybody. That first of all, you basically go through a triage of your investment portfolio. What is the impact? What is the liquidity? Where is the hedge? Similarly, if you don't have an economist in your team, you still try to get a sense of the economic impact assessment. Perhaps by attending this call, you get that. But then there are issues in the insurance industry in terms of underwriting exposure review. But you can make this point a general one about what is your exposure, where is your trade credit, what is the cost of your marine cargo, and what are the political ramifications of all these things. Then how do you communicate to your stakeholders? Because I think just like we are trying to be as communicative as possible to our clients, you as your fiduciary would have to talk to your clients and then get them a sense that you know where you stand with respect to these opaque tariff-related developments. And then for financial institutions, certainly big re-examination warranted with respect to capital adequacy. Let me stress this point a little bit, because we could be running into solvency-related risk very soon. See, goods trade is not a high-margin business. Services can be very high margin. Generally speaking, the goods world is a competitive world. Companies run on low margin, but they focus on high volume. You can talk about a t-shirt business, you can talk about a tire business, you can talk about pharmaceutical business. Everywhere is the same thing. You run on low margin and you run on high volume. What the US is doing is putting the margins under the threat of tariff and huge amount of threat on the volume side as well. Because once the margins are very, very narrow or even become negative, you might have to just reconsider how much market you have anymore that you can address. And if you start saying, I can't really address the US market, all of a sudden, your projected volume would be substantially lower. And things that look completely fine from a balance sheet perspective, from a revenue perspective yesterday, will not look fine tomorrow. Hence, the capital adequacy check, not with a reinsurer in mind, not with a bank in mind, but with the entire industry in mind. That's why we put it up there. Then there are issues related to scenario planning and monitoring counterparty risk. Very, very important. Now, we are a price taker as far as the U.S. is concerned. U.S. has set ground rules for trade, commerce over the decades, and we have more or less gone ahead with it. Today, we are reacting to what the Fed has done, or for the U.S. government has done. And we are, if we are Japan, we're basically not going to reciprocate or retaliate. We will just try to negotiate with the U.S. to get an exemption. If we're China, there's not a lot of leverage, but we might put some mitigating measures as well as some retaliation. If we're Europe, maybe a little more power, some more retaliation. But all of this entails the assumption that the U.S. is so powerful that it can just dictate whatever it wants. I'd like to stress the fact that this would be the case if the U.S. model was internally coherent. I think U.S. model right now that is being pursued is not internally coherent. What I have on the screen right now are 4 key contradictions we see in the Trump model. Therefore, we probably will see the markets trying to push these contradictions to the fore by selling off, by showing weakness, and that might, just might, make the Trump administration rethink about some of the things that they're trying to do right now. Contradiction number 1, tightening immigration does not give you a lower cost of living. It gives you a higher cost of living. The US is in the process of having lower number of undocumented workers, which means less people in American farms, less people to do US home renovation, less people to work in the food industry, not just agriculture, but food processing, delivery industry. And that would mean a higher cost of living. Second, tax cuts and a lower fiscal deficit do not go hand in hand. The kind of tax cuts that the government of the United States has in mind between making the old tax cuts permanent, the Trump 1.0, as well as coming up with a few new tax measures, are in the trillions. Under no circumstances would this tariffs amount to trillions of dollars in revenues. U.S. only imports $4 trillion worth of stuff. You can't have 25% tariff on all imports and not expect demand to go down substantially. So even if the demand curve was vertical, 25% tariff on all imports would bring in $1 trillion in revenue, and I can assure you that is not going to happen. A, it's not even 25%. B, if it were 25%, there'll be a huge amount of demand destruction. Third, tariff and competitiveness. We've seen these through history. We're going to belabor the point. Companies and sectors that will be enjoying the benefits of tariff will have outsized margin, will deliver a lot of return to the shareholders, but they will become uncompetitive because they don't have to deal with the rest of the world. And finally, weaker US dollar and lower interest rates, impossible. It just can't happen. No matter how much Mar-a-Lago type agreements that the US government tries to push through. I'm sure some of you are aware of the Stephen Moran paper. For me, doesn't make any sense at all. All right. These are a couple of slides that Martin put together, and we've been looking at it in terms of sectoral vulnerabilities. So when you look at, for example, U.S. top 10 sources of car import, Mexico, Japan, Korea look really, really vulnerable. And if we're indeed going to have 25% tariff on finished automotives coming to the U.S., you can expect that the Hondas and the Kias and the Hyundai and Nissan and Toyotas of the world will have tremendous amount of downside to their earnings going forward. That doesn't necessarily mean that this is a boon for all the U.S. manufacturers like Tesla, who largely source from the U.S., because there are issues related to desirability of those brands, availability of the supply that in those categories are also questionable. So we could see a supply crunch before anything else, before we start celebrating the win for Tesla in this context. On the semiconductor side, Malaysia is most vulnerable. You may remember the chart that I showed earlier. Does not look that they have been at the forefront of the tariff. It is substantial nonetheless, and their exports to the U.S. has picked up a lot, and FDI in Malaysia has been going through the roof in recent years. But then Taiwan, Vietnam, Korea, Thailand are also there in the top 5 list on the semiconductor side. So the region as a whole will be quite vulnerable to the semiconductor-related tariff. And note that China, Japan are also in this list toward the bottom end of the list. Finally, on the pharmaceutical side, I was on TV earlier today talking to an Indian TV channel, and they were pointing out to me that the Indian pharma stocks are all up 5-6% because of the exemption that has been announced. As you can see, India ranks number 5 in the world in terms of top pharma exports. Actually, I'm surprised by that. I would have expected India to be higher because I read somewhere that 1 in 5 prescription filled in the US happens to be sourced from made in India drugs. But yeah, we've got Singapore and India perhaps benefiting somewhat from the exemption that the administration announced earlier today. All right, 2 more slides before we are going to go into the Q&A, because there are lots of questions to deal with. How many, Hunting? Heading toward 2 dozen now. So I would like to talk a little bit about company-specific strategy in dealing with this trade war right now. One could be that you do what you did in Trump 1.0. You talk to the supply chain participants and you tell everybody, look, there's a 20% tariff, you take 5, I take 5, we get the upstream guys to take 5, and then they pass on to the consumer on the 5. We can probably manage, lower profitability, but let's at least keep our businesses going. I don't think it's that straightforward now, given the magnitude of the tariffs, but that would be one thing. But at the same time, it would not be the only thing. You'll also have to accept some hit to your margin and your profitability. And then thirdly, if none of those things are sufficient, then you start thinking about solvency issues. This was not on the table during 2018, 2019. This, I'm afraid, is going to be on the table. And my fear is, through the course of today, that issue has not really come to the fore yet. But do expect this to show up in the coming days, because I hasten and go back to my point. Goods-related manufacturing, despite all the supply chain efficiency and amazing logistics we have, is a very low margin business. It cannot survive 30-40% tariff. What about economy level? As I said earlier, we did this earlier today in cooperation with all the DBS economists in the team. These numbers are not alarmingly large. Martin sees substantial downside to Taiwan, about 180 basis points to the 3% forecast, and Hanteng Chua sees about 2% downside to Vietnam's growth from 6.8, so we're going to be substantially sub 5 this year. But other than that, we are all looking at, kind of one-ish impact. Oh, sorry, forgot about Thailand. Thailand looks pretty bad as well. But beyond that, Taiwan, Thailand, Vietnam notwithstanding, everywhere we're talking about 0.25% growth or 0.5% growth here and there. Not the end of the world. Malaysia a couple of years ago would have been great to have 4-ish growth, and despite the tariff announcements today, despite the sectoral exposure to the US, we're talking about, again, 4-ish growth in 2025, even after the tariffs. So I wouldn't worry too much if I were Malaysia. I wouldn't worry too much if I were Singapore, looking at just about 0.5% of GDP downside. But let me just sort of talk about my country, and because we will talk a lot about all the other countries later. By my country, I mean the country of my coverage, not the country of my citizenship, United States. US, we were looking at close to 3% growth 3-4 months ago. Then we started to sort of, have sort of inclination to revise downward US projections for 2025. Even before the tariffs were coming in, the view was that 2025 was going to be the year when US consumers begin to show some sort of fatigue, having consumed a lot in 23 and 24. And the fact the savings rate were sort of beginning to fall, the fact that wages in real terms were growing only mildly, not a whole lot, meant that there was time for the US to not go back to sort of trend growth. But now that trend growth is under threat, we are talking about 0.5% downside to growth, coming mostly from postponed investment and some degree of canceled consumption. And of course, the federal government would not be contributing substantially to growth the way they did during the Biden years. But my fear is it could be more than 0.5%. It really depends on how long these tariffs stay, what happens to demand when some of those tariffs do materialize in higher domestic prices. And then we also come to the conclusion that the Fed will not be able to support the economy substantially. But Eugene can weigh in on that later. All right, I'm done with my set of slides. Back to the Pigeonhole QR code. We have a lot of questions, but feel free to submit more questions as well. Okay, maybe I take the first question from the WebEx, and then we'll start taking questions from the pigeonhole, because this question seems to be addressed directly at me. It is from Justin. Your analysis of economic model inconsistencies is interesting, but it seems to me that Trump is more concerned about the politics, and it's a case of hoping that the economy can hold up while the process on his political aim. What are your thoughts on this? I don't think he's that big into the political implications. Of course, he wants the U.S. to be more powerful than ever before, hence his territorial aspirations with respect to Greenland and perhaps Panama Canal. But by and large, Trump is an old man, and he has very old-fashioned views, and he doesn't change. If you see Trump's full-page ad in the New York Times that he took out in 1987, almost 40 years ago, his language at that time and his language today is identical. That's boilerplate. The whole world takes advantage of the U.S. U.S. trade deficit is a bad thing. We need to bring manufacturing back by putting up tariff and addressing trade-related concerns. No change there. And hence, while today we're sitting in 2025 and we're talking about a complicated global supply chain and all the ramifications, the fact of the matter is it's a very old-fashioned person with very old-fashioned ideas is trying to bring back blue-collar jobs in the U.S. because perhaps he thinks that's the right thing to do. Sounds idealistic, but also because in his world view, that will pay for the tax cuts he wants to make permanent, which of course will help his billionaire donors and funders. So this is the reason we sort of wanted to focus on the inconsistency, because we think that the things that he wants to get, he will not get because it doesn't have a coherent model. All right, let's now go to Pigeonhole. Are we displaying the questions on the screen, or we're not going to do that? We're not going to do that, right? Okay. Hunting, can we go to the Thailand questions first? I think these are at the very top.
Yeah, these two.
Okay, so we have two questions on Thailand, and we'll start with that. Yeah. So one is, how much would the 36% tariff on Thai exports reduce Thailand's GDP growth? So we've sort of touched on that already. Could this lead to a wider current account deficit if exports to the U.S. decline sharply? How might the BOT respond? Hunting, just bear with me. Let's take the second question as well. Yeah. The Thai Chamber of Commerce estimated. Our screen is jumping around.
I think the questions are moving up.
Yeah. Here we go. About 2% of GDP for U.S. tariff on earthquake. Yes, the earthquake issue is also there. How will this impact Chinese exports and? Oh, that's.
Questions are moving. Yeah. I think a lot of interaction.
Which are the safe sectors for investment? Okay, I think you got the gist of the questions, right?
Yeah. So I think maybe I'll answer a question now and relate it directly to tariffs. And I think in our slide we clearly showed that Thailand is one of the hardest hit, and the growth impact, which we estimate is around 1.5 percentage points to growth. And I think that's really quite a shock for the Thai authorities, which in that sense are going to react to the Trump tariffs. And I think on the point about a wider current account deficit, I think for the current account, it probably will be quite mixed, because for Thailand, they also import quite a lot of things for exports to the US. So on that current account, equation, that might be a bit mixed at this juncture. Lastly, on Bank of Thailand, I think this would be seen as a huge shock for Bank of Thailand. Currently, we are expecting 25 basis points rate cut in 2025. I think there's risk that Bank of Thailand might do more, 50 basis points or more, and even front load some of these rate cuts.
Thank you very much, Hanteng. Radhika, how well is India placed in this tariff war? Would it impact Indian market? And how bad would it be? Which are the safe sectors for investment and cautions in short and long term? So quite a few. Shall I repeat the question, or you got it?
Yeah, I'm okay. I think. Thank you so much, Taimur. Certainly, I think from India's point of view, when this conversation about the reciprocal tariff started back in February, India was one of the few governments which actually administration reached out to the US, started negotiations, started conversations, even around the bilateral trade agreement. And first of that is supposed to be, the first phase is likely to be by fall of 2025. So essentially, the door is still open for further conversation. And now coming back to the reciprocal tariff, even a day or two before this announcement was likely, we were tracking the comments quite closely, and it was quite clear that the US was, was in agreement with the way India was approaching this whole thing. But still, I think there was a report by the USTR earlier this week, which spoke a lot about the role of non-tariff barriers that were in place from India's point of view. So I would think if you just look at it from a tariff differential point of view, this 26% is more than 2.5x. So certainly a big role by non-tariff barriers, and almost in all the sectors we've actually seen a negative tariff differential. That is India imposing higher tariffs on the US rather than the other way around. So I would think in terms of the impact, fortunately for now, we see exclusion of pharma and semiconductors. I say for now because one doesn't know. We don't think it's going to be at 0%. So there's going to be some announcement perhaps later segment-wise, just like auto, something else could come up for these few sectors. But apart from that, I would think the maximum impact at this point is certainly auto-related segments. I would think a bit more labor-intensive like gems and jewelry. Then electronics, textiles, some of these sectors are the ones that we'll keep a close eye on. And as a final point, I think, and as perhaps a silver lining, would be that there is a bit of a comparative advantage still in India's hand on 2 points. Number one, conversations, discussions, negotiations are still going on. So I think there is room for reassessment. And the other one is that when you see from an electronics and supply reconfiguration point of view, as there are some suppliers who have moved away from China and have set up base in India. So the tariff differential, we disregard the cost of manufacturing, but the tariff differential certainly puts India at a bit of an advantage as compared to some of its regional peers. I think this is how we would, interpret what's going on.
Auto sector, India?
Certainly, so auto sector, it's been interesting. India is a more active player in the OE and auto exports, auto component space. In fact, there has been a lot of discussion. We do know we were speaking to some clients, back in India, and they also were sharing with us that there was this, some of them looking to move in closer to the US earlier, say about 3-4 years back, looking to move closer to the US. So as far as even Mexico to try and export to the US markets. Auto, as of now, is still about a 25% tariff. Even if it's on the final component, a final auto vehicle, that will percolate down to the components as well. So I think there will be the need to look at this sector quite closely. We do think there's going to be a net impact, perhaps more than the other segments, particularly in electronics and semiconductors. So we would be a bit guarded on our view. But then again, this is more a macro view. I wouldn't necessarily equate that to equity point of view if that was what the intention of the question was.
Thank you very much, Radhika. Mo, you're there?
Mo,
Can you hear me?
Not very well.
Can you hear me?
Yes, better.
Good.
So the question is on China, and I'd like you and both Ting to weigh in because it's an inside out and outside in question. The question is, aside from China, many Asian countries are also charged higher tariff. How will this impact Chinese exports and ODI to these ASEAN countries? So more like, not Chinese exports and ODI to the rest of the world, but implications of what just happened today from China's perspective into ASEAN.
Yes. Recently, I was in Beijing. So given the current, U.S.-China trade tensions, so for the Chinese manufacturers, now they are forming another mindset. It's about they want to, in terms of the expansion ODI to the ASEAN countries, they want to also adopt a strategy like, made locally, sold locally. So this is something I think, exactly the same as, the U.S. companies in China. They are also made locally, sold locally. I think by the end of the day, this will be one of the strategy, for the Chinese companies to counter the current, tariff headwinds.
Ting, you want to weigh in on this issue?
Sure. I think for Chinese companies, the strategy of investing in South Asia, in fact, will remain basically unchanged in the longer term. Well, if you look at the tariff rates, the reciprocal tariff announced on China more than 30%, and adding the 20% already imposed in February. So in total, it's 54%. But for countries in Southeast Asia, the reciprocal tariff rate roughly is around 20 to 30%. So there will be still some tariff gap between China and certain countries in South Asia. So for trade diversion, I think actually the opportunities will remain in place.
But not to Cambodia or Vietnam?
No, not Cambodia and Vietnam, but more to probably like Malaysia. Yeah, Malaysia, I think the tariff rate is only 20% plus. Yeah, so there's a tariff gap between China and Malaysia. And another point is that the local consumer demand in South Asia, in fact, is also growing. This region is already a 3 trillion economy, and the growth rate is also at 4%, 5%, on par with China's growth rate today. So from the local consumer demand perspective, I think there are also reasons for Chinese companies to continue to invest in this region.
Ting, this is an interesting point. It came up in a conversation I had with a client earlier today, which is that, yes, Southeast Asia is a big market. China can probably expand its market share in autos and textile, et cetera, in the region and take advantage of the big market. But the region also has its own protectionist genes. It wants to protect its local textile manufacturers and local car companies and so on. So could there be a risk that the China shock coming from South Asia starts creating some backlash? So not only China has to deal with reciprocal tariffs from the US, but just when it thinks that here's a way to offset some of the loss, Southeast Asia turns against the Chinese.
Yeah, for this part, in fact, we have done some analysis. So which countries in South Asia, in fact, they have competition with China. And the result is showing is mainly Vietnam has a lot of competition with China in a wide range of industries, from textile, like you mentioned, to electronics and machinery. But for other countries in South Asia, at a macroeconomic level, we think they are actually complementary to China. They're not really competing with China, still complementary. Perhaps for certain industries like textile, there is competition between Indonesia and China as well, between Thailand and China as well. But macro level, I think most countries in South Asia, in fact, they are complementary to China.
Okay, Ting, this is really important insight, and we need to sort of showcase this for our clients going forward, because these are the kind of questions I think we'll have to deal with. Let me take a couple of questions myself. I think lots of stock market related questions. Unfortunately, we don't have our equity strategies with me, so I'll just take it on myself. How much further will U.S. stocks, in particular tech stocks, fall? I wish I knew the answer to that question. When would be a good time to buy? Look, the valuation story for U.S. stocks is not a favorable story. The yield gap, which is the dividend paid by U.S. stocks minus the return on safe assets, is extremely large. And the fact that the safe asset return has gone down a little bit still does not change that dynamic in a meaningful manner. By historical standards, the US PE, US yield gap suggests valuations the level that we have not seen since the years before the global financial crisis in 2007, 2008. So if you have gone up that much, there's always room to correct. And I wouldn't be so keen on trying to bottom fish at an extremely uncertain time like this. But if in the coming months and quarters, we see two things. One is the market is sort of reaching a point of capitulation, because right now, every day there is a sell-off. You will see a huge amount of retail buying. Tesla is a classic example. The fact that it has had relentless decline in its asset price, stock price in the last 2-3 months has not deterred the retail buyers from loading up and doubling up and tripling up on Tesla. So that tells you that there is no sense of capitulation in the market. This is not the time to buy those things yet. But going forward, if we see signs of capitulation and we see signs or early signs of policy response from the Fed, then maybe we will have a fairly favorable cycle to look forward to. But that time is not yet. One more question is on gold. What's your view on the gold price after the announcement? I think we should talk about both gold, and if Wei Yang is on the call, we should also talk about digital gold. Wei Yang, are you there or are you? Oh, I think Wei Yang is on a different call. He's not here yet. I'll take both of those. So what's your view on the gold price after the announcement? The gold price view is very constructive. Gold price rallies when there's a lot of geopolitical uncertainty, and boy, oh boy, do we have a lot of that. gold prices rally when there is some degree of concern about inflation. In fact, the relationship between inflation and gold is actually not that great. It's a little good, but it never really falls at a time of high inflation or inflation-related anxiety, but it certainly goes up at a time of geopolitical anxiety, and we have a lot coming from the US. We have a lot going on still in the Middle East, in Ukraine, and now we have the whole tariff-related uncertainty. So I think that outlook for gold remains very constructive. And by the way, when we talk about gold, its price in the past used to be driven by retail demand because the Chinese and the Indians are very big buyers of gold jewelry. That is not the case anymore. These days, gold price on the margin is driven by institutional demand as well as central bank purchases. Both of these are here to stay. I'm pretty sure about that. Okay, we will move to currencies. Philip, are you on the call?
Yeah, I'm here.
Thank you, Philip. Very straightforward question. What's your view on currencies?
Okay, I think if you look at the reaction after the first week of March, where we had this big jump in the euro, then markets have been preparing for, yesterday's or today's Liberation Day. So by and large, at this point, it seems like the European currencies are doing pretty well. But it's the Asian basket that concerns me, primarily because of the, I think, higher than expected tariffs that we are seeing. But you're also seeing that the allies seems to be, the currencies of the allies seems to be doing better. For example, in Asia, Indian rupee has done pretty well, but that's because they are also negotiating a deal, which may be a showcase to lower the tariffs that's just been announced. Then on the other hand, we are seeing I think the Southeast Asian currencies, particularly the Vietnamese dong and the China plus one countries, which also are the new BRIC members this year, being affected by the tariffs. So, but going forward, very mindful that we've gone from pandemic to high inflation to trade war. I'm not a long-term dollar bull. In fact, I'm quite bearish on the dollar longer term. But at the same time, we are given like what you've seen just now, the analysts will be downgrading growth. So Asia, is facing a lot of downside risk. There's no winners on the growth front. Also mindful that the US businesses have been front-loading imports to beat the higher tariffs. So we'll probably get less demand out of the US. Then EU tariffs, likely to offset the spending hopes that we've seen from the Rearm Europe plan. And China, and Asia will probably be looking to Europe for the exports and, vice versa. So then again, there's also the risk that Europe and other, DM current countries may also be looking to impose, their tariffs on their imports as well. So lots of things to consider, but at the same time also to be very mindful of that every currency has its own story. Every currency has their own level. Even though the sterling is very bullish right now, it still has a quite pivotal resistance at 133.50. So the same can be said for the euro at around 112. Now that it has broken above 110. But nonetheless, I think going forward for the second half of the year, I'll probably be paying more attention to the Asian currencies.
Thank you very much, Philip. And just as we were speaking, William has walked into the room having done a different meeting. William, since we just talked about currencies and before that we talked about gold, given the uncertainty that we have around the world right now, what's your view on cryptos?
Right, so we just put out our crypto publication today, discussing whether or not the fact that risk appetite has been so negatively impacted, could that mean that we could see a very large sell-off in cryptos? So I think this time around is different because we are seeing a trend of more and more corporate participation in Bitcoin markets. And there are two important aspects that corporate purchases of Bitcoin are different from institutions purchases. One is that corporates, they are basing purchases on business reasons, not necessarily subject to financial market volatility, and they're not so sensitive to risk appetite. So that's one reason why the sensitivity of Bitcoin prices to risk appetite could be lessened, because we have a new source of demand among corporate buyers. And the second reason is that corporate funding sources for their Bitcoin purchases, they're typically done through very long-term capital funding instruments, usually equity, preferred equity, convertible bonds. What that means is that they have holding power, so they are not necessarily obligated to be in a rush to exit from holdings, because investors are demanding their money back and so on and so forth. So that's the second reason why Bitcoin could be more resilient this time round, despite the high uncertainty in the markets.
Thank you very much, William. We will now move to Indonesia. Radhika, can you elaborate the impact to the Indonesian economy? Any idea what sort of response the government of Indonesia can do?
Yes, certainly. I think for a start, we are quite surprised by the steep increase that's been allocated to Indonesia. I think because if you see the tariff differentials, quite in contrast to our earlier comments on India, India's tariff differentials are negative in the sense that India charges higher than the US, but for Indonesia's case, it's a lot more mixed like that. And if you're seeing your screen, you can see that in the weighted average tariff rates that we have here. There are some that Indonesia charges higher and there's some US charges higher. So it's a very mixed picture. But despite that, quite a hefty 32% tariff being announced. So that aside, I think what can be done to better balance this? I think we had expected some kind of pushback from a China point of view, in the sense that the US might see in the strong linkages that Indonesia has in terms of investment as well as trade with China, that could be a potential flashpoint. So let's just assume that's one of the reasons why the tariff has been imposed at such a high level.
So my other speculation is that they don't want Indonesia to become the next Vietnam.
Quite possible, absolutely. So they want to put the brakes at this point, and also important to I think take into consideration the kind of industry or that China is playing a big part in Indonesia's case, especially in the commodity space. So that again puts Indonesia apart, a bit different from the other countries. So what can Indonesia do in reaction? Of course, at this point, Indonesian markets are not reacting because there's a week-long, almost more than a week-long break for Lebaran. But when the markets come back, when the government does get together to react, I would think, again, reaching out to the US, trying to understand why this kind of steep tariff rate, and perhaps trying to strengthen relations with the US. And I just want a final point. Under the Biden administration, there was this move to, which was US's flagship investment scheme, which was the IRA. Under that, Indonesia was finding it difficult to invest into their critical mineral requirements. So the government was looking to ink an critical commodity agreement, a kind of watered down version of the FTA. But again, that didn't come to pass. So I would think that revisiting that option is also something that could be considered. All in all, Indonesia really needs to, has been actively and needs to do more of that, which is to move away from just being very commodity and downstream oriented to much more manufacturing. And as a positive sign, finally, US Apple has been given permits after Apple has mentioned that they're going to invest about 300 million into Indonesia in terms of R&D and in terms of some manufacturing facility, that iPhones can finally be sold in Indonesia as well. So I'm sure it's going to be a lot of back and forth once the onshore markets are back online.
Thank you, Radhika. I think that it'll be a huge shock when the Indonesian markets reopen. I don't think they saw this coming. Hanteng, could Singapore benefit from this tariff war through a reordering of supply chain or in other ways? If so, what are some of the opportunities for Singapore?
I think as shown on this slide and what Tamer showed earlier, the cross-section scatter plot, in fact, Singapore, I think, is in a relatively better position during this reciprocal trade war, as is subject to just the baseline tariff rate. So the differentials with respect to other peers in the region are certainly looking better. And I think Singapore remains quite open to trade as well as incoming investments, and therefore I think investments will continue to flow into Singapore. And I think with respect to that, what are some of the opportunities? I think Singapore, Johor, the SEZ that's going on there would still be, an area that businesses would look to invest in, and that also help to relieve some of the constraints that Singapore have. And I think the other thing is that Singapore is in a better fiscal position to deal with all these uncertainties compared to perhaps other economies in the region with deficits. But yes, certainly directly more insulated, but I think we also need to be mindful of some of the indirect risks that Singapore might be faced with respect to its integration into supply chains and exposure to broader global trade and manufacturing slowdown.
Yeah, I think today's the market reaction is all about the direct impact. I think in the coming days, there'll be better appreciation of the secondary impact because I think Singapore, because it is so well embedded in the regional supply chain, the secondary impact may not be trivial, it might be substantial.
Yes, I think the indirect impact might be quite consequential, but I think directly certainly
not that bad, yeah.
Not that bad.
Yeah. Eugene, a couple of questions on rates. First one is a general one, which is what's your view on rates? The second one is a Fed question, that how will the Fed balance inflationary impact versus growth implications?
Any slide?
No. Yeah, I think the concept on rates, right, is to understand that we are in a risk off, and it is engineered volatility, engineered an outlook of stagflation like for the US, and rates have moved accordingly. Right, so there is some flight to quality, and treasuries have benefited. Insofar as some of it is again generated, there doesn't seem to be anything seriously wrong with the US economy at this point. Then it becomes how long would this flight to quality and depressed rates stay? So I think as long as the worries are here and you're going to be awaiting retaliation from the other economies, then I think the news flow could be somewhat negative for a while more. As to how the Fed will react, I think you still need hard data to soften. And tomorrow's set of labor market numbers would be quite critical because we are in a soft patch for sentiment really, right? So if we lurch into a period where even hard data is not holding up, things could get uglier, right? But if hard data continues to hold up, we could have the curve inverting even more because the Fed will have conflict of objectives. So you'll be able to hold rates high for a little while longer, but the flight to quality will show up in the longer end, right? So it's not so straightforward.
Yeah, Eugene, we're not going to talk about the whole Stephen Moran plan to put surcharge on U.S. holding of treasuries. That's a subject for another day. But yeah, given the tariff situation, flight to safety and the dollar smile, I think stays there for the short term. But I'm with Philip. Longer term, it's hard to be optimistic. But the near term, I guess you don't want to fight the U.S. fixed income market, nor do you want to take very negative view on the dollar in the short term, at least. Tiying, there's a question on the semiconductor industry. So the question is, what is your view on the semiconductor industry's impact in Taiwan?
Sure. For semiconductor industry in Taiwan, I think the direct impact from the reciprocal tariff may not be too much. One important reason is that for the advanced semiconductors, Taiwan has a very high market share globally. So TSMC already accounts for like 80-90% of the global foundry in advanced semiconductor below 7 nanometer. So not merely alternatives for the US importers, but for the mature technology semiconductors, there will be alternatives. I think the alternatives will come from South Korea, will come from Malaysia. So Korea and Malaysia, their reciprocal tariff rate, it's about 20% plus, lower than Taiwan, which is 32%. So for mature technology semiconductors, there will be some substitutes and weakening Taiwan's market share. But I think a bigger concern, in fact, is about longer term. So longer term, as we know that TSMC has already committed to increase U.S. investments further by $100 billion. That's very huge investment. And that will include 3 chip foundries in the U.S., 2 advanced packaging and testing facilities, and also 1 R&D center. So in the long term, I think the company's production cost certainly will increase. Profit margin will be under pressure. And another concern is that if the U.S. Semiconductor production capacity increase, whether it will reduce or narrow the production capacity gap between Taiwan and U.S., and also narrow the technology gap between Taiwan and U.S. in the semiconductor sector. So I think longer term, there will be some negative implications.
I think the big fear for Taiwan is if the US forces it to move its center of excellence in chip design manufacturing to the US, then what happens to the security umbrella that they think that the US has guaranteed them? So I guess this question, actually we start with Radhika, maybe then we go to Mo on this question, but it's really about India first, but it's China related. So the question is, will the tariff imposition lead to dumping by China in other countries? So this issue was already there, the overcapacity question, but what is this in the context of India? And how would India sort of calibrate the wave of chip manufacturing coming from China?
That's certainly a very important question, and I think that's where this whole conversation on cascading tariffs come in as well, which is that if tariff rates have increased to this level, all of the countries concurrently are going to look for other markets that they can sell into. And certainly India being, quite a significantly big country with a sizable middle class population, it looks like a very conducive market as well. From India's point of view, investments from, at least from the investments point of view, it's taking a case by case, approach towards investments from China. But if we talk about the manufacturing part, certainly India's biggest trade deficit is with China at this point. But the authorities are quite mindful of not having it, widen further. They would rather prefer Chinese companies, again on case-by-case basis, or some of the other, say the US or the European companies to set up base in what is called, Make in India or Atmanirbhar self-reliance India. So set up base manufacturing in India rather than just export final goods. And if you take this example of what has just happened, especially on the very recently, India imposed a 12% safeguard tariff on steel for purchases from China. So I think that is going to be the approach wherever there is an indication either in chemicals or in steel or any other segments where there's a sudden increase in shipments. India is likely to put some countervailing tariffs. So it certainly is going to be a very evolving situation, but I think the authorities are very mindful of that and keeping track on what's going on as well. As an extension, Vietnam has also done the same thing, which is basically, look at increased imports from South Korea and China on steel and have levied some counter tariffs as well.
Thank you, Mo. There was a request for a clarification on one of the China charts. I think it's the second one. So the question, I'm just going to read the whole thing to you. So rather, could the China strategist explain her charts on the slide just shown? On the left-hand side, it's China's exports to US by product. On the right-hand side, imports from China, but the numbers don't quite seem to gel. Just want to walk us through one more time what these charts are showing?
Yes, this is like, for the US, currently, US has been levied 20%, now 34%. The in total is 54%. So by industry, it varies, such as, for electrical machinery, that's accounting for 24%. But if you see in the down the line, by the end, how much it will be added, for the total, like, the tariff is over like 70%. But for different sector, it's different. But even the lowest is still at 55.5% for toys and sports equipment, but the highest, the hide and skis. So this is 92.7%. So different are different, but all of this is much, much higher than the Trump 1.0 time. So this is like cannot be only the producers from China to bear, but also mostly it has to be absorbed by the US consumers. And also I'm about to add a little bit. Yeah, sorry.
Sorry, Mo, just in the right-hand side chart, the farthest column, US import value from China in 2023, and it shows electronics 0.2 billion. I'm maybe not following it.
The same chart there.
This column.
Oh, you mean the last?
Right, right. So that's, I suppose, the question
it has,
is that,
it has to be. Yeah, it has to be flipped around. Yeah, it has to be flipped around. Yeah, the machinery should be the highest. Yeah, it has to be
okay,
flipped
so
around.
okay, so the answer is
So
congratulations,
sorry,
Justin,
sorry
you found an error in our slide.
Yeah,
we'll
yeah.
fix it in this
Thank
week.
you,
All right,
thank you.
Thank you.
Yeah, but I also want to, is there
Sure.
time? Yeah, I just want to add one more thing about, just now people talking about like, China dumping, China ODI, et cetera. One of the key questions in the state leadership's minds now is about what is the appropriate, sufficient equity demand for China. But it is what you make meets what you need. But China makes more, so that's why China has to export, China has to do ODI, China has to do the Silk, Road, et cetera. So this is something in the top leaders' mind. What they want to do in the next reform agenda is they want to make sure the government expenditure, mainly on domestic public goods, that can solve the global dumping scenario. Yes.
Thank you so much, Mo. Appreciate it very much. Okay, final question because we're running out of time. We will do a Macro Insights live stream next Tuesday. And for those of us within DBS, we have one more call next week as well. So this is just the beginning of us trying to suss through all that's happening. But the final question is, what remedies is being taken by the Trump government to the local companies to sustain on inflation from this tariff regime, like reduced corporate tax rates and what percent, and introducing relaxations of specific product groups? So I think the short answer to that question is that the government, of course, has a bunch of salvos in the pipeline. One is a wide range of deregulation, which they think would energize investment, particularly in the fossil fuel sector, but elsewhere also there's a lot of plan to cut red tape. And the second is this big multi-trillion-dollar tax cut that is in the pipeline, both by making the previous Trump tax cuts permanent, as well as adding a few more, including some of these deductions that were taken away in the last Trump tax measures. But I think that going back to the four internal contradictions in the model of Trump, you can't really support the local economy that much with tax cuts because expenditure cuts by DOGE is tiny, fractional. And as a result, the overall implication for the fiscal deficit would be worse. I don't think Trump really wants that to happen. So let's see whether his desire to give tax cut is overtaken by his desire to secure some degree of fiscal responsibility. I feel it might be the former and not the latter, and which again makes me worried about whether the market is rallying too much with respect to the fixed income market, because we will see volumes of issuance coming for the rest of the year. Okay, we started with close to 800 people. We're ending it with close to 600 people. I'm glad that I've held on to your attention and my team has provided such excellent responses to the questions. We will be at your service in the coming weeks and months as we try to work our way through this trade war. It's going to be bumpy. Keep your seatbelts fastened. Stay healthy, stay safe, everybody. Until next time, take care and goodbye from the team.
Bye-bye.